In this video, traders, we're going to look at a modern earnings gap strategy. Stay tuned. Hey traders, warm welcome to you. So I've done videos on gap strategies before, but with the market dynamics and environment changing so much, and I believe a lot more surprise earnings and bigger gaps, I think it's time to refine and adjust the strategy and just cement those rules if you're interested in trading these gap plays on equities, specifically in the US markets. Okay, so what we're looking for here now is earnings come out and they are significantly better or worse than expected, and because of that, from the close to the next day's open, there's a big gap in price. So we're talking, 5, 10, 15%, that kind of thing, to the upside or to the downside. And that is because the earnings have changed fundamentally the perceived valuation of the company, whether they're for the better or for the worse. It just says, people say, okay, this is now a repriced company for whatever reason, and the general consensus is that the price is worth plus or minus 10, 15%, whatever number you're looking at. Now, order of magnitude, you want really something more than 5%. You really want kind of 7% up, because you need, this strategy works well when it's ultimate surprise. And the bigger the surprise, the bigger the gap. Now, you're going to have to adjust this depending on the size of the company you're trading. If you're trading something like, Apple, Tesla, then your order of magnitude 7% or something is going to be very, very high. If you're trading a kind of smaller biotech, less liquid, 7% is nothing, does that every day. You're going to need sort of 20, 30% moves. So adjust it depending on the kind of company that you're trading, the shares in issue and that kind of stuff. But what we're looking for is we're looking for surprise earnings that gap, and then we're looking to follow the gap. Now, I've talked about gap strategies where we can fade the gap and little rules on price action, etc., how we can read the intraday trade to suggest, give us an idea or give us some clues whether we're going to fade the gap, follow the gap, and how to structure it from that. This is specifically following the gap after an earnings surprise and what we're looking for. So first one is looking for a surprise earning, or first rule is, should I say, is a large gap on surprise earnings. It's got to have been a surprise earnings. People have got to be talking about it. They've got to say, hey, this is way better or worse than the street expected, and it's catch loads of people out. Why is that important? Now, it's important because when people have a general consensus and something else happens, it's going to fuel trade volume and order flow, because the people who are on the right side of it may well say, great, that's fantastic. I knew this company was doing well, let's pile in more. People on the wrong side of it are going to say, wow, that's really caused by surprise. We don't want to be on the wrong side of that. Let's cover our trade. If we're on the short side, we're talking for the long. We're talking for a long spike. So you can see the more extreme we get, the more likely the supply-demand imbalance is going to be greater, the bigger opportunity for us on an intraday basis, and also from a swing trading basis, guys. Not just an intraday trading strategy, although its premises that it can last for multiple days, if not weeks, if caught right. So large gap surprise earnings. Number two, gaps outside of range. What do I mean by this? So this is very important as well. And by the way, all these rules are important. We don't put them in here for the sake of it. If you're doing this, let's say, and then we get the next day gapping there, and that's gapping up 7%. If the yearly range is there and we're within the yearly range, that's no good. It's no good because nobody cares. All the long-term, higher money traders, bigger money traders, higher time frame traders, should I say, don't care about that. What you really want is something that's gapping out the range, preferably new yearly highs, new yearly lows, or half yearly, or something. Have to be specifically a new yearly high or new yearly low, but has to have taken out a pretty decent amount of the price action. So it's fresh territory for the past 50, let's call it for a year, 52 weeks. So fresh territory for the past 52 weeks to the high side or the low side. And that again means that more participants are going to be pushing in one way or the other. We need the participants, guys. You can see this is the kind of things we're looking for. Surprise to bring more participants in, to bring more money flow in, and the outside of range again to bring more money flow in. Because if we get that money flow coming in, then we have the opportunity. If we don't have the money flow, then gaps start to stall, they start to reverse, they start to mean revert, we don't get supply demand shift and imbalance. It's important to have that. All right, so number three, pre-market trend. What do I mean by this? So Very often, specifically in the US, we'll have evening earnings. They come out, the market moves, and then pre-market, market opens before the bell goes, there'll be some trade happening. Now, what we want to see is a trend, a very clear trend that's causing that gap. We don't want to see chop and revisiting lows and range, and it's gapping, but it's just luck depending on where it's opened in that range. We want to see a very clear supply-demand imbalance, a very clear trend, pre-market opening near the top 30% of the trend if we're gapping up, or the bottom 30% for gapping down. Don't want it reversing against it. We want a nice clear demand in one direction for the upside, or supply coming in for the downside. That's very important as well, guys. I'm not recommending trading that pre-market, but just using that as a premise and a filter to say, hey, you know what, this could be something that's going to present opportunities when the bell goes. Number 4, potential longer term reversal. So this again is important because we're bringing in that higher time frame money, the bigger money. This could be that, hey, you know, this market or this price has been, going down for a long time. The earnings have been gapping it down. All of a sudden, earnings have changed. Now, why is that important that we've got a potential long-term reversal? And this is for the earnings cycle, by the way, which will generally also show in the chart potentially. If we've been trending one direction, a lot of people on the short side have been making money. A lot of people on the long side have been waiting for a reason to come in. They're not stabbing at it now, they're waiting for a reason, a catalyst. And so people on the short side who have been with it for a long time, then they see the earnings cycle potentially change. People who are, again, higher time frames are trading based on earnings cycles. If they think the cycle now might start getting better and they've had a lot of profit in the deal, they're going to probably look to cover the short. And what cover the short means some buying pressure. Same people who are looking for an investment sticking in a portfolio on the long side, like it, haven't liked the earnings cycle, have said, you know what, let's see what the next quarter earnings do. If they start to improve, then we'll start to accumulate some stock. Then you can see how demand comes in and how we can get that shift. So that's important as well to see if potentially the earnings cycle is changing. When we get that, we have potentially the opportunity, if we're gapping in the direction, to follow the gap trade. So we're looking to buy in some kind of price action. If we're day trading, this isn't specifically for day traders, so we're not going to go drill right down into specifics of that. But if you're interested in price action stuff, make sure you stay subscribed, guys, because we've got some great stuff coming up on that. But we're looking to buy in the direction of the gap. When these criteria are all ticked and we say, yep, you know what, that looks good, then how we trade that intraday is up to us. We might be a swing trader, we might literally buy the open and have a stop kind of under the gap, and we're looking for multi-quarter move. If we're a day trader, you might want to finesse it a little bit and buy a double bottom or buy a first pullback after drive or something like that. Like I say, let's not go into too much detail in this video about it. The point is, it's filtering so that we get gaps that potentially have the most likelihood of running away in the direction they've gapped, and that is large gap with surprise earnings, gaps outside of a range, pre-market trend in the direction of the gap, and the potential longer term reversal in the earnings cycle. Modern gap earnings, gap strategy, guys. Keep an eye out for that. If you like trading earnings, this is a great time to be involved in it. Take care. Whatever you do, keep the risk managed. Bye-bye.